Jim Kelvin was a retired cattle rancher from Texas. He had developed an interest in the futures market during the years when he would hedge his livestock at opportune prices. After he sold his ranching business, he began to experiment with a few small trades as a hobby. Jim read everything he could find on futures trading. He studied all the technical models, read manual after manual on market analysis, attended seminars, and kept point and figure charts. In time, he felt he had a firm grasp on all the factors that make the market tick and began to look at trading as a serious vocation. He wasn't making money, but he thought he was just paying his dues as he learned the intricacies of his trading system. One morning, Jim got up at 6 o'clock, as he always did, and went to his study to turn on his quote monitors and prepare for the market's open. He picked up the Wall Street Journal to see what the bank traders and brokerage analysts were saying about the foreign exchange market. He had been watching the Japanese yen closely because he felt the recent depth of coverage in the news would surely reveal some good trade opportunities. The U.S. dollar was expected to record new lows because of a slowing U.S. economy and consistently negative trade balances, forcing the yen and other currencies higher. All the foreign exchange-related articles on his quote equipment news service were bullish for the yen. A good friend and fellow trader called and commented on how the currencies should rally that day. Jim then checked the 24-day channel model and the 16 to 32-day moving average crossover model, two longer-term technical indicators on which he frequently based his trading. Both had been generating buy signals for some time. Jim glanced over his charts and volume numbers and chewed on the end of a pencil. At the end of every day, he conducted a personal analysis of the market structure and wrote down possible trades for the following day. Last night, he had written, "Weakening yen, look for opportunity to sell." The yen had been in an upward trend for some time, but in recent weeks, volume was drying up. Price was moving higher, but activity was decreasing, and there had been no substantial moves to the upside in over a week. He knew from his ranching days that less volume was significant. When he would auction off his livestock, the price would continue up until the last buyer had bought. When the auction was nearing its end, the bulk of the buyers would have dropped out because they had fulfilled their inventory requirement or the price was too high. When no one was left to buy, the auction was over. He read his analysis again. Common market sense told him that the up auction in the yen was over. There were no more buyers. But what about all the fundamental and technical indicators? All these professionals can't be wrong, Jim said to himself. I can't sell the yen. The market was going to open in less than 5 minutes. Jim stared at his blank monitor for a moment, thinking about what his friend had said. He put his hand on the phone but did not pick it up. The yen opened higher, rose a few ticks, and then stalled. The floor traders were acting on the recent bullish sentiment, but the buyers that had driven the yen up for the past month were nowhere to be found. He just sat and watched his terminal. It's going to break. I should sell, he thought. The flashing green price on his quote screen began to drop as he sank deeper into his chair and indecision tightened its grip. What happened? Jim Kelvin's decision-making process was jammed by the conflict between his own intuition and popular opinion. How can the majority be wrong? The majority of people who trade futures don't make money. In fact, over 90% aren't successful enough to justify being in the market. If you trade with the majority, then you will fare only as well as the average, and the average market participant does not make money. He was caught, like the goat that starves to death between two piles of hay, in the conflict of multiple sources of information indicating opposite conditions.